Good evening. It is time for today's tax talk. I'm your host. I'm attorney Stephen Leahy. Lots going on out there with the IRS, and all the information's coming in, still coming in about the Inflation Reduction Act and how many people are is the IRS going to hire, and who's going to be audited, and all of this. That's what we're going to talk about today. Today is Thursday, September 8th. The year of our Lord 2022. And again, that's what we're going to talk about today. We're going to talk about the IRS and audits, and how maybe you can prepare to get around the audit. Won't you join us? Well, the best audit is one that never happens, right? And so you have to ask yourself, well, what can I do to prevent? There's no 100% way that you can prevent an audit, because sometimes they pick people randomly, and so you might be a random pick. But there are things you can do to avoid the audit. Being audited, because there's red flags that will cause them, the IRS, to take a closer look at you. And so I wrote this article some years ago. I think it's 2015, so some years ago. And things have changed a little bit since then, but not that much. And so I'm going to go through it quickly. I have a couple of articles that I might want to read also. One's about IRS audits and the statute of limitations. And we'll talk a little bit about that. I have another good article about what the IRS might do with the 87,000 new employees, and it ain't good. I don't think anybody could say, well, I have heard people say it's a good thing. The IRS really, they're just getting back up to par. It's going to be fine. The IRS needs twice as many people. We need to give them double their budget. And I have to be one that says, no, we don't. It's ridiculous. It's what free country would do this? But here we are. Who's the fascist? Oh, just asking. So let's go through and let's start there. Let's start with with my article. So here's my article. Again, this is looks like February 26, 2015. And I'll skip to here are 9 red flags the IRS uses to select a return. Now, I know all these red flags, and I tell people one of the best ways to avoid an audit is to first, if you're in business, set your business up correctly. Many people get audited because they want to do an LLC and put all of their business expenses on there. Going to save a little bit of money, put it on your personal tax return, or you're sole proprietor and you're putting all your expenses on Schedule C, and that's what Schedule C's for. I get it. But if we've talked a lot about this on the show, because if I've had many clients who've had problems with tax preparers. Sometimes tax preparers will prepare your tax return and you won't really look at it, right? You're happy to get the big refund that they're giving you, or that they're getting you, I should say. And then when it's time that the IRS starts coming after you, then I probably shouldn't have done that. So one of the things that people do when they lie on their tax returns, and again, whether that's the taxpayer or a tax preparer that's doing it for you, and you don't really understand what they're doing, but all they're doing is they're getting you a big refund, and that's good, you think, until they come after you. But one of the things they do is they make up a business and they put a lot of expenses on your Schedule C. And so this is a common way. So if you have the legitimate expenses on your Schedule C, it's still a red flag, because if people were lying, that's what they would lie about. That's what they'd make up these expenses. And so it's an easy fix for the IRS to just say, hey, let's see those expenses, right? And so it's a red flag. So again, first, structure your business correctly. If you're going to stay in business, treat it like a business and set it up correctly. Structure your business So and then your business should have its own tax return, and the tax return, you can take all your expenses on the 1120, right? The corporate tax return. That's what I would suggest usually to my clients. What would be right for you? That's something we'd have to talk about. Remember, I don't give any legal advice here on. I just read the news. Okay, so here's the 9 that I have here. Make a mistake on your tax return. They have error letters that they send out, and if you make a basic mistake, it's going to pop up, and that's they're going to send you a correspondence audit usually. It says here, this is what you said, this is what we found. It's just a letter. Round off the entries of your tax return. So if you have $37 here, and all of your figures are round numbers. 25,000, 15,000, 7,000. There's no 6,747. And that's the way real life works. So when you are, if you're inputting round numbers, that's a red flag that those numbers aren't accurate. File late or not at all. When you file late, a person does look at your tax return, and where if you file on time, you could be caught with electronically with everybody else, and they don't have, and oftentimes a person will not review your tax return. So that be a tax protester. A tax protester is the people that believe that the IRS doesn't have the authority to tax them, and they take a position that it's all a lie. Take that with the IRS, and you'll find out that you will be audited, and you may go to prison, like Wesley Snipes. Remember? Bet on black. Have unreported foreign accounts. This is big now, right? More and more, these foreign banks are reporting your income to the IRS and your bank account's existence. And so maybe you don't know it, but if you have a foreign bank account, you're supposed to report it to the IRS. And I've got to tell you, most people don't know that. And many foreigners who come here and they start filing their tax return, they have money in their home country, and they don't realize that they're supposed to report it, that the law requires that they report it. Don't report some income. Companies are to issue 1099s. These are information returns. Sometimes that will cause an audit, but you'll definitely get what they call a CP 2000, which says here, this is what you said, and this is what we found. Tell us why we're wrong. And usually you can't, because you didn't report that income. Now, you may have reported it and you just didn't attach the 1099 to your tax return. And that, if I'm in business, and I report all my income, I would have reported the income. A client sends in a 1099, I never get it. I still reported the income. So I wouldn't be taxed that way, but I have to explain it. Where is that? Claim large charitable contributions. This is another way that tax preparers can get you a big refund by making up a number. And you don't even realize they're doing it often, but they make up some number and put it in there. And next thing you know, the IRS, it's a red flag, and the IRS wants, hey, and they could send you a letter on this one too. Hey, show us the receipts. Show us what you've given. And so you don't even get a full-blown audit. You just get this, what they call a correspondence audit. Hey, show us prove to us you have these receipts for charities. And often if you don't have the receipts, and that's another thing, right? Keep good records. Always keep good records. Because if you get audited, that's how you can overcome an audit. I've helped a lot of people in audits, and many times it's not that they take deductions that they're not entitled to. They just don't have the records to prove that they're entitled to it. And so if you don't have the records, then you don't get it. And that's just the way it is. Take repeated loss on a home-based business. Oftentimes the IRS will come up and say, well, wait a minute, this is a hobby. I know you're trying to be a photographer, right? You sell some photographs to some people, and you take all this equipment off, and you're a big loss because you're buying a lot of great photography equipment, and you sell maybe a couple $1,000 worth of your pictures, and you might buy $10,000 worth of equipment. Well, that $8,000, the IRS is going to say, no, That's not a business. That's a hobby. You don't get to deduct that. Use an unscrupulous tax preparer. A lot of this comes down to that. And I've had a lot of people who use unscrupulous, and as I mentioned over and over again, that they make up things on your tax return. You don't know, you don't inspect it enough, and you don't even see it. But again, if you're getting a large refund, inspect your tax return, because there's a good chance that there's something false on there. Because most tax preparers, they're going to come up with a similar number, not always exact, but similar. And if one person says, "Oh no, I found all these great deductions," probably a problem, and that's a red flag to the IRS. So, and when they find these unscrupulous tax preparers, then they audit everybody's return that they ever did. Because now remember, if you pay someone to do your tax return, their name should be on your tax return, not yours. Don't let them put your name. They're supposed to sign off on it. And if they don't, then there's that's a red flag to you that there's a problem. So, so make sure that they sign off on it. And if it turns out that they're unscrupulous, well, then the IRS will go back and they will audit every return that return preparer did. So that's the ninth. That's the ninth one. I already talked about business. Structuring your business right. That's the way to that a lot of this red flags are gone, because all of this is on a different tax return. It's not on your personal tax return. Now they can still audit your business, but again, if you keep good records, there's less likelihood to be a red flag because of expenses on your. Now that doesn't mean you take wild deductions, because the IRS knows what they have records of every business that's doing the same business you do, and they kind of know what your expenses should be. Because here we've got just pick a number. There's 50,000 people in America who do this, and this is what their average expenses are. And I don't know. Let's say it's 57% of whatever their gross income is, and you come in and your expenses are 80% of your gross income. Well, that's probably a red flag, right? And they're going to take a look at that, and so you have to be vigilant. So again, filing a business tax return doesn't eliminate the chances of a audit. Nothing can eliminate the 100% the chances of an audit, but you can decrease the odds, and that's what you want to do. And with this surge in the IRS, this is what you want to do. One of the good things is, so let me talk. Okay, so one of the things is that the IRS can go back 3 years. There's a 3-year statute of limitations on your tax return, on how long they have to audit you. That's why if you get audited, you're generally going to get audited for 3 years. Now, there's other ways they can go back. They can go back 6 years sometimes. They can go back unlimited. And here's a good article. Let's see if we have the time here. What time is it? Well, let's see if we can fit this article in, because it's very good. This is Mr. Woods of Forbes. He's a very Wood, I should say, Robert Wood. He's a very good. He does a very good job with tax stories. With 87,000 new IRS agents on the way now, that the Inflation Reduction Act is unleashing a tougher IRS. There's a lot of tax it should be talk probably about tax audits. The widely published 87,000 figure appears to come from a 2021 Treasury Department study saying that the IRS would hire about that many with $80 billion of funding. In any event, there's more talk of audits. Tax returns are annual, and getting them filed also means starting the clock ticking for how long the IRS has to audit you. But when might you be in the clear? Your audit exposure is at least 3 years from when you file your tax return, from the date that it's due, actually. But you might be at risk for years more. In fact, the time periods can be downright frightening in some cases. Tax lawyers and accountants are used to monitoring the duration of their clients' audit exposure, and so should you, if you want to watch a calendar until you are clear of an audit. In most cases, that will be either 3 years or 6 years. But in some cases, even though you filed and thought everything was in order, the statute limitations never runs out. Let's start with the basic 3-year rule. But in many cases, IRS can audit 6 years not 3. So if you are thinking you only need to look over your shoulder for 3 years, that isn't always so. For example, the usual 3 years is doubled to 6 years if you omitted more than 25% of your income. If you overstate your cost basis on something you sell, that counts too. So if it has an effect of understating your income by more than 25%, the IRS gets 6 years. The 3 years is also doubled if they omitted more than $5,000 of foreign income. So a lot of this that you're going to see is tagged to foreign income. That's why it's so important that if you have a foreign bank account, that you report it, and that you not only report it in the FATCA, but also but on your tax return. Even if you disclose the account, there are just some 13 key IRS statute of limitations rules. Even worse, don't omit Form 3520 for gifts and inheritance for foreign nationals, or Form 8938 for overseas assets. If you skip one of these forms, the IRS clock never runs, even starts to run. Of course, the IRS has no time limit if you never file a return. For unfiled tax returns, criminal violations, or fraud, the IRS can take its time. In most criminal or civil tax cases, though, the practical limit is 6 years. If you haven't filed in 20 years, usually you only have to file 6 years to get in compliance. If you own part of a foreign corporation, it can trigger reporting, including filing of Form 5471. It is an understatement to say this form is important. Failing to file it means penalties, generally $10,000 per form. A separate penalty can apply to each Form 5471 filed late, incomplete, or inaccurate. This penalty can apply even if no tax is due. Wow, that is harsh. But the rule about the statute of limitations is even harsher. If you fail to file a required Form 5471, your entire tax return remains open for audit indefinitely. This override of the normal IRS statute of limitation is sweeping. The IRS not only has the indefinite period to examine and assess taxes on items relating to the missing Form 5471. In fact, the IRS can make any adjustments to the entire tax return with no expiration until the required 5471 is filed. Think of a Form 5471 like a signature on your return. Without it, it really isn't a return. Forms 5471 are not required of U.S. shareholders in controlled foreign corporations. They are also required when a U.S. shareholder acquires stock, resulting in 10% ownership of any foreign company. The harsh statute of limitations rule for Form 5471 was enacted in 2010, part of the same law that brought us FATCA, the Foreign Account Tax Compliance Act. The possibility that the IRS can audit forever is chilling. The potential for large civil penalties and perhaps even criminal liability can be real. Consider your audit exposure before you file. For example, if you don't sign your return, the IRS does not consider it a valid tax return. That means the 3 years can never start to run. Another big no-no is if you alter the penalties of perjury language at the bottom before you sign. If you do that, it also means the tax return does not count. Some well-meaning taxpayers forget to sign or may unwittingly change the penalties of perjury wording. Some other taxpayers just miss a form to end up in audit purgatory. An example of the latter can arise if you have an offshore accounts held by a company. If you miss one, the IRS can audit you forever. If you file early, do you shorten the audit period? Normally, no. The IRS audit clock starts running on the later of the actual filing of the due date, whichever is latest. If you file in January and your return is due on April 15th, the audit clock starts to tick on April 15th. There are lots of IRS statute of limitations rules to know, so be careful out there. So I thought that was a good article about it because we're really talking about, first, if you're going to get audited, you want to avoid an audit if you at all can. But if you can't avoid an audit, then how far can they go back? And then what can I do to make an audit go my way? No 100% rule about this, and I have a good article. It's in the description. A gentleman talking about when he was audited about a boat that he owned, and the auditor took a nasty position against him, and that happens sometime. And that's sometimes it makes sense not to do this yourself. In that article, I recommend you read it. But he says I talked to my CPA. I said, do I need a tax attorney? Oh, no, you don't need a tax attorney, the CPA said. And then he said he incurred about $100,000 in CPA fees. Well, why would the CPA want to give it to the attorney, even though the attorney is better suited for something like that, in my opinion? In my opinion. So thanks so much for joining us. I appreciate you taking the time. IRS audits are coming. It's going to take the IRS a couple of years, though, right? Because we've talked about it on the show. They have to train all these people, and that's going to take them some years, and even to get them on board. You know, I think our last show was the propaganda, that all this propaganda out there. Google 87,000 IRS, and you'll see all of the. Oh no, it's not true. Oh, don't worry. It's all If you look in there, there's lots of. Oh, there's not going to be 87,000 new auditors. Well, that's true, but I don't think anybody says that. There's not going to be 87,000 armed guards. Well, that's true too, and I don't think anybody says that too. So they take this extreme position and say, "Oh no, it's just false." Well, it is true that they're going to hire 87,000. That comes from the Department of Treasury. So how long is it going to take them to get them on board and then get them trained? Well, that's a matter of process, and it's going to take some time. I also wanted to note that the Inflation Reduction Act, you know, I always have to laugh when I hear that, also included $40 billion for the EPA enforcement. $40 billion for EPA enforcement. And that can spend it all this year. So they more than quadrupled their budget, the EPA enforcement budget. That's kind of scary, if you ask me. I didn't say that to scare you, just to, you know, be vigilant. You have to follow the rules. Make sure you do. Running a company means you have to follow the rules. And that means, you know, keeping good records. We can help you do that here at Open Tax Advocates. So let us know if you need our help. Ask you to like and subscribe. We need your help. Get the word out for this. Remember, most news stories involve taxes. How do they get the money? How are they going to spend it? And we talk about that here first, usually. So thanks so much for joining. Again, thanks so much for joining us. Remember, if you have IRS problems, if you owe the IRS money, if you have unfiled tax returns, if you overpay your taxes, first thing you should do, get a copy of my book, Deal with Your IRS Problem Today. Go to freeirsbook.com, freeirsbook.com. Get your free copy. We will ask you to pay a small shipping and handling fee, but other than that, the book and all the bonuses that are included are free. So thanks so much for joining us. Appreciate you taking the time. And we'll be now tomorrow. We're on. We have the Trust Radio Network at 2:00. We're going to stream live at 2:00. Attorney Olafson is going to be with us. He was with us about 2 months ago. Great interview. You won't want to miss it. Love talking to attorneys. Thanks so much, and we'll see you tomorrow, I hope.